All right, let's get right into it. There was a bank failure earlier this year, and on the surface, it really didn't seem like a big deal, just a minor event. But what if it wasn't? What if it's actually the first real warning sign of some much bigger problems lurking just beneath the surface of our financial system?
So picture this. It's late on a Friday night, January 30th, 2026. Most people are winding down for the weekend. But behind the scenes, regulators are quietly stepping in to seize a small community bank in Chicago called Metropolitan Capital. Over that weekend, they transfer all its assets to another bank, and boom, by Monday morning, for the customers, it was pretty much business as usual.
And the official line from the FDIC? Well, they called it a textbook resolution. Said the cost was tiny, under 20 million bucks. The message they were sending was crystal clear. Hey, this is just a small, isolated thing. Nothing systemic to see here, folks. Don't worry about it.
But doesn't that sound familiar? That's the exact kind of everything's fine language we've heard right before a huge crisis. It forces us to ask the really important question here. What if this wasn't just some random one-off failure? What if this is the first domino to fall? The first real sign that something in the system is fundamentally broken?
So to really get why this little bank failure could be a huge deal, we've got to rewind the clock a bit. Let's look back at the last big one, the 2008 financial crisis. Because honestly, the parallels are kind of spooky. They show you exactly how a problem that everyone says is contained can, well, spiral completely out of control.
Okay, check out this timeline. It all started in February 2007. A subprime lender, New Century Financial, goes under. And what did the officials say? You guessed it, the problem is contained. But then, over the next year and a half, one thing led to another. Markets freezing up, Bear Stearns collapsing, until bam! September 2008, Lehman Brothers files for bankruptcy, and the whole world is in a financial meltdown. It just goes to show you, the first domino never looks like the end of the world.
So if we're thinking of Metropolitan Capital as our new century moment, what are the big cracks in the system today? Well, when you dig into it, there are two huge interconnected risks that are putting a ton of stress on the whole banking system as we speak.
All right, the first crack, get a load of this number. Almost $400 billion. That's the total amount of unrealized losses sitting on bank balance sheets. See, when the Fed jacked up interest rates so quickly, all those older, low-interest bonds that banks had bought, their value just cratered. Now, as long as the banks don't have to sell them, it's just a loss on paper. But it's a massive, ticking time bomb just sitting there on their books.
And this slide just lays out perfectly how that vulnerability turns into an absolute disaster. It's like a death spiral. Let's say depositors get spooked and start pulling their cash out. The bank has to sell those bonds to get money, right? But they have to sell them at a loss. Suddenly, that paper loss becomes a very, very real loss, a giant hole in their finances that completely wipes out their capital. And then the bank fails. This isn't theoretical, by the way. It's the exact playbook that took down Silicon Valley Bank back in 2023.
Okay, on to the second crack in the system. And this one's a biggie. It's the slow-motion train wreck happening in commercial real estate, or CRE. We're talking about a $3 trillion exposure for banks. And the whole game has changed for this sector since COVID.
And this breaks down the why perfectly. Just think about it for a second. All these loans for office buildings and malls, they were made based on property values from before the pandemic, a world that just doesn't exist anymore. Now, thanks to remote work, a lot of those buildings are sitting half empty. So when those big loans come due for refinancing, the banks look at the building's new, lower value and say, no way are we lending you that much again. This forces the owners to default, and the banks get stuck holding the bag, an asset that's worth way less than the loan. And get this is exactly what took down Metropolitan Capital. It was bad loans to a commercial real estate portfolio.
So let's recap. We've got two huge risks looming, those unrealized losses on bonds and this ticking time bomb in commercial real estate. The billion-dollar question then is how many other banks out there are just as vulnerable? And could one failure set off a domino effect, a systemic cascade?
And this is where things get really concerning. When you actually look at the public data from the FDIC, you find that dozens of banks have these paper losses that are worth more than half of their entire capital cushion. And for a few, those losses are actually bigger than 100% of their capital. Let me say that again. The paper losses are bigger than all the capital they have. Simply put, that means they're technically insolvent. If they had to sell those assets today, they'd be wiped out. The only reason they're still in business is because of some accounting rules that let them pretend those losses aren't real yet.
This table here shows you just how fast things could go from bad to worse. A few more small banks fail? Okay, no problem. The FDIC's insurance fund can totally handle it. But what if one mid-sized regional bank goes under? Now we've got a serious problem. The fund could actually drop below its legal minimum. And if several regional banks fail, or heaven forbid one of the big systemic banks goes down, we are in full-blown crisis mode. The fund gets depleted, panic sets in, and you're looking at a massive government bailout.
Okay, I know that's a lot of doom and gloom. But look, the point of this isn't to freak you out. It's to get you prepared. Because knowledge really is power, and there are absolutely concrete things you can do right now to protect yourself and your money, no matter what happens in the wider system.
All right, your first and most powerful line of defense is FDIC insurance. It's simple. It's a U.S. government guarantee on your cash. The magic number you need to burn into your brain is $250,000. That's the limit. But here's the key. It's $250,000 per depositor, per bank, for each account ownership category. And that last part is really important.
And you can actually use those rules to your advantage. This is a perfect example of how a couple can insure up to $1 million at just one bank, all by structuring their accounts the right way. See? One individual account for spouse 1. That's $250K covered. Another for spouse 2. That's another $250K. And then their joint account is covered for $500K because they each get $250K of coverage in it. Add it all up, and you get $1 million. It's a super powerful tool that, honestly, most people have no idea about.
And you don't have to just sit and wonder. You can actually be proactive and do a little detective work on your own bank's health. All this information is public. You can find it in something called a call report right on the FDIC's website. And you can look for the exact same red flags we've been talking about. Are their capital levels low? Do they have a huge exposure to commercial real estate? Are their unrealized losses massive compared to their equity? The answers are all there.
So to wrap up the practical stuff, here are 3 final protective measures. Number 1, diversify. Seriously, don't put all your eggs in one basket. Spread your cash across different unrelated banks. 2, think about holding some emergency cash. I'm talking about physical bills outside of the banking system. Why? Because if a bank does fail, even your insured money might be tied up for a few days. And 3, just understand how this works. If you're insured, your money is safe, period. But any money above that limit, you become a creditor and you have to file a claim. And there's no guarantee you'll get all of it back.
So what's the bottom line here? Look, the failure of that one small bank, Metropolitan Capital, it wasn't some huge headline-grabbing event. It was quiet, it was orderly, most people didn't even notice. But as we've seen, history tells us that this is exactly how massive crises can start. It was a tiny signal, a faint tremor, hinting at a much bigger fragility in the whole system. The first warning shot has been fired. The only question left is, are you listening?